Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Suzana Shakirah binti Mama Fero. My number matrix is 0282082042. I and my friend will present about macroeconomy problems under employment and inflation. Lecturer name is Encik Muhammad Yusuf bin Amri. My group member is Siti Nurjanah binti Abdul Manan and Aini Sofia binti Jasmine. What is business cycle? Business cycle, also known as a trade cycle, refer to the regular fluctuation in economic activity in an economy as a whole. Important to element of economy. Business cycles also refer to a wave-like fluctuation in aggregate economic activity, particularly with regard to national income, employment, and output. According to Keynes' definition, a business cycle is composed of period of good trade with rising price and low employment in percentage, followed by periods of bad trade with falling price and high employment percentage. Phases of a business cycle. Business cycle has 4 phases. First, peak or boom. Second, recession. Third, trough, and fourth, recovery. This graph is show about the expansion and contraction periods. What is expansion? Expansion is the period in a business cycle where it moves from a trough to a peak. Example like where output and employment is increased. What is contraction? Contraction is the period in a business cycle where it moves from a peak to a trough, during which output and employment is declined. Peak or boom. What is peak or boom? Peak or boom, also known as peak period. The economy is at full, employment will are available, resources are employed. Economy will experience a high of output and trade, increasing effective demand and higher employment level and income. Business optimized creates more investment and increased pressure of unavailable resources that lead to an increase in wage and price of input. Peak or boom, also known as the prosperity period, can be a situation where the number of jobs exists, the number of workers like the situation is known as overfull employment. There will be an increase in price, wage, interest, and profit. It will come to an end when the first favoring expansion is slowed down. What is recession? Recession will take place after the period of prosperity ends. This process is characterized, number 1, an increase the level of employment. Number 2, a reduction in aggregate income in terms of wealth and profit. Number 3, a decline in consumption, expenditure, and investment level. Number 4, a decrease in the volume of output, trade, and transaction. The downward process is also called a contraction. A deep and prolonged recession is known as a depression. A recession normally lasts for a 6-month period with a continued decline in real GDP. What is trough? Trough is the recession ends when the real GDP stops falling. The minimum profit is called a trough. The trough will last until there is an increase in real GDP. The overall level of economic activity will drop to the lowest level. Employment rates during the phases will be higher and create many problems. It is a period of great suffering and hardship to society and the worst phase of a business cycle. What is recovery? Recovery is a period of revival lending to upturn of the economy. The economy level of output and employment expand toward full employment during these phases. The recovery period is entitled by government expenditure, change in production techniques, new innovation, and exploitation of new sources of energy. The increase in government expenditure will stimulate the demand of consumption of goods and will increase the demand for capital goods. The employment level, output, income, wage, price, and profit will start to increase. Through the multiplier effect, the economy will move upwards rapidly. Phases of a business cycle have four. Peak, output to maximum level, employment is lowest level. Recesses, output is declines, employment is increased. So output is minimal level, employment is higher level. Recovery, output is increased, and employment is decline.
Hi, Assalamualaikum. My name is Aini Sofia binti Yasmin. My metric number is 02082 0F2016. Today I will present about the inflation. Definition of inflation. Inflation can be defined as a continuous increase in the general price level goods and service in the company. Refer to continuous increase in the general price of every product and service need not increase. Types of inflation. First, rapid inflation, a sustained rise in price about 2% per year. Mid inflation is sustained rise in price by about 8 to 10% per year. Hyperinflation occurs when monthly price rise by 50 to 60% or more. Germany encountered hyperinflation in 1922, Hungary in 1944, and China in 1949. Effect of inflation, distribution of income. Inflation charge the anxiety factor of distribution of income and wealth in society, where some group are relatively better off the other. The people who stand to gain from continuous inflation are businessmen who earn higher profit from rising price, property owners such as real estate owner who gain when property price increase during inflation, shareholder who receive higher dividends since company's profit are higher, debtors because the real value of money has changed. The people who tend to lose from continuous inflation are people dependent on fixed income such as salary, worker and pensioner, holder of government bonds, holder of fixed deposit in banks, and holder of life insurance policy and money. Creditor because when they receive the money on them, the real value of the money will be less. Saving during inflation, the value of fixed deposit, bond, life insurance policy, and money will depreciate in terms of real income. Real income is the purchasing power of the money as measured by the quantity of goods and service that can be purchased. With it as inflation depreciated the value of fixed deposit, people will save less, invest in non-financial sectors such as house and land. Production during inflation, the general level price rises and producers make higher profit, providing their whole old stock. This will lead producers increase their level of production in investment. Increase production and investment will create more job opportunity and reduce employment. Last, balance of trade during inflation. Many countries face a deficit balance of trade since imports are greater than export. And this arises when the price of domestic product increase, as this make them less attractive or for foreigner, thereby leading to reduction in the demand of domestic product. At the same time, import increase because the imported products are now cheaper than domestic product.
Hi, my name is Siti Nurjana Amanan. My metric number is 02D8020F2030. And now I'm gonna tell about measure of inflation. The Consumer Price Index, which is CPI, is an index that measures changes in average price of consumer goods and service. The CPI is also called the Cost of Living Index. The computation of the CPI will discuss in the next chapter, which deals with simple and weighted price index. The formula is in the box, which is inflation rate equal CPI this year minus CPI previous year divide by CPI previous year and multiply by 100. And the bottom box is the example of the formula. Here is the measure to control inflation. The measure to control inflation have three methods, which is monetary policy, fiscal policy, and direct control measure. Monetary policy. First, open market operations, selling of securities or short-term bonds. The sale of short-term bonds or government security or treasury bills to the public and banking community by the central banks. Directly reduces to the total amount of cash balances in the public's asset portfolio and cash reserve with the commercial banks. Second is raising the reserve requirement. The central bank would raise a reserve requirement to reduce cash resources in commercial banks and force to restrict their lending activities. A rise in reserve requirement would reduce the ability of commercial banks to provide loan, and this will ultimately lead to a decrease in the supply of money. Third is raising the discount rate or bank rate. A rise in the discount rate or bank rate also raises the price of borrowing funds from banks for business community, and this forces the banking system to re-examine its lending policies. Fourth is raising the interest rate. The central bank will persuade commercial banks to increase their rate of interest of deposit from the bank. The high rate of interest will attract and encourage more people to save, and this will increase the level of savings. Fifth is selective credit control policy. The selective control credit policy takes the form of issuing directive to commercial banks prohibiting them from lending against certain communities or reducing the total credit limit granted to the public. Fiscal policies. First, increase in taxes. A highly regressive tax structure can successfully reduce the impact of inflation on the economy. An increase in taxes will reduce the disposable income of individuals and their consumption of goods and services. This in turn will lead to a fall in prices. Second is decrease in government expenditure. A reduction in government expenditure will affect the aggregate demand. The government will cut the salary of all civil servants and postpone its development project to reduce the purchasing power of the public. Lastly, direct control measure. First, price control and rationing. The government will control the prices of goods by fixing a floor price and a ceiling price. Rationing is used as a last resort if the measures are failed. Rationing is where consumers can purchase limited goods and services using coupons. It is practiced in some countries where the government controls essential goods. The second is anti-hoarding campaign. This arises when reports are made against producers and consumers who store goods unnecessarily because such storing can cause an artificial shortage and push prices up. The third is compulsory savings. It is essential to introduce a compulsory savings plan. This could be by way of a deduction from the salary of workers that is credited to workers' account. In Malaysia, this body is known as Employees Provident Funds. The amount credited into the workers' savings account can only be withdrawn upon retirement.